Hey everyone, it's Ben Hardy here, and in today's video we are actually going to be talking about how to improve your credit score over a short period of time, or just really the quickest way to improve your credit score. And in the first part of this video, I'm going to be going over the general tips that'll just work for all sorts of situations to help you get things with your credit. And then since this is an automotive channel, I will cap off the video with talking about things that you can do that pertain to your auto credit to help with getting a car loan, since I'm sure a lot of you that are going to be watching this video are going to be more worried about that aspect of it. And with all that being said, just get right into the video. Now, this is going to be kind of like a dummy's guide to credit. At least I'm going to try to just really simplify things, because I feel like a lot of people that talk about credit, they're always these crazy finance people and they just like make everything way more complicated than it has to be. So the first kind of misconception I see about credit is people not understanding that you have to build up credit in every aspect of your life. So you have to build up credit that's associated with like a home mortgage. You have to build up credits associated with auto loans and credit cards and all that. And if you just have one thing, you can have a high credit score, but that doesn't necessarily mean you have good credit that'll allow you to get really good loans. And a really good example is me personally. So I got my first credit card when I was 18 years old, and it was about a $500 credit card. Now, I was really good with it. I put all of my expenses on the credit card, but I paid it off at the end of every month. So I never rolled over a single dollar in terms of balance from month to month. And this built up my score very quickly. The first time that I had my credit pulled after I had gotten that credit card was, I think, about a year after I'd gotten it, and my score was around 800, which that's a really high credit score. And here's where the things got a little bit complicated. The reason I was getting my credit pulled is I was trying to get an auto loan at the time. And so if you guys just kind of look at credit as like just a really like simplified view, you're gonna go, oh, well, he has a really high credit score, so he should be fine for getting an auto loan. It's not how it works. So what I had to do is I had to put a lot of money down to get that auto loan to go through, because I didn't have any auto credit history. So it's not just about the score, it's also about the different type of loans that you have had while you've had credit out. And since I had never had a car loan before, it definitely made it difficult, and I had to do some things, go through some hoops and everything to get that first loan. And now that I've had several car loans at this point, it's very easy for me to get approved for a car loan for a good interest rate as well. And so that's the first misconception, is people just not understanding that there's different types of credit and you have to build up your credit on all fronts. So what does this really look like by building up your credit on all fronts? So my first piece of advice, which actually relates to the story that I just said, is I would recommend everyone to, and that Porsche is really loud. Anyways, I would recommend everyone to get a credit card. And depending on your, I guess, habits and everything, I obviously would recommend to increase the limit as much as you can, because that actually helps out with your credit. But if you are worried about your spending habits and you're worried about you putting tons of money on the credit card, then keep the limit really low so that you make sure that you don't put a ton of money on it, and that you're also going to pay off the credit card at the end of every month. This is another big misconception I see, is people saying, oh, you want to keep some money on the credit card because if you keep some money on the credit card, it'll show that you're using the credit and build your credit. That is not reality. So just using the credit card itself already builds your credit. Keeping money on the credit card is completely pointless. That actually doesn't really help your credit. Now, if you are keeping money on the credit and you are paying interest on it, then obviously you're losing money to interest. And if you're rolling over money on the credit card every single month, on top of that, that shows as reoccurring debt on your credit. So it actually can negatively affect your credit. So the thing that I'd recommend the most with credit cards is, again, increase the limit as much as you can, as long as you have some self-control through spending. If you don't, then make sure to keep a low limit on the credit card. Pay off the entire balance at the end of every month so that you don't pay any interest on the card, and so you don't have any reoccurring debt on the card rolling over to each month. Now, most cards do have a thing where if you pay like a certain minimum, then you won't pay any interest on the card. Again, that's okay to do it, but I just wouldn't recommend it, because it is going to show on your credit report saying that, hey, this person, you're rolling over $200 every month. So then they're going to be like, oh, that's the same as you having a $200 monthly payment, and that'll kind of get into the next part. Let's get into the next piece of credit that you want to build to quickly build up your credit score, and that is going to be with an auto loan. Auto loans are great for building up your credit in general because it shows that you can consistently make a monthly payment on something, and for most of us, that's just what we're going to have to do do financially. I know that you hear all the time, pay cash for a car, pay cash, pay cash, pay cash. Well, here's the reality of it. The average household in the US makes less than $60,000 a year. That's the average right now. The average new car is about $38,000. So it's just not realistic for a household that's making less than $60,000 to go and pay cash, aka almost their entire yearly salary for a new car. So most people are gonna have to finance. That's just the reality of it. And people giving you crap for financing and all of that, well, I guess that they're just lucky because they have so much money that they can end up doing that. But for us regular mortals, we have to take out auto loans. And again, this is something that's really gonna build up your credit anyways. Now, the things that I would say is it doesn't have to be a massive auto loan. Just having an auto loan is going to positively impact your credit. And so if you wanna pay less interest, yes, having a lower auto loan, and what I mean is just a lower money amount, is going to be the best. Now, if you really wanna boost your credit, paying off the entire auto loan is what's going to boost your credit the most. So first off, you want to show that you can make regular payments. So making your regular payment, if you want to make double payments, you pay less in interest, that's great. But going through and eventually paying off the auto loan, that shows as such a huge positive on your credit. It boosts your score, and also to creditors, it shows, hey, this person is capable of making payments on a regular basis. And not only are they capable of making payments on a regular basis, they're also capable of paying things off. And so both of those things will massively boost your credit. Now, the next thing is going to be having a mortgage or a house loan, and this is something that also massively boosts credit. Now, a lot of people nowadays are having to rent just because, especially where I live, house prices are just keep going through the roof. And I have a lot of people that watch my videos from California, and I know I feel bad for you guys. House prices over there are astronomical. I know there's other places in the US that they're crazy as well. But having a mortgage really helps out with your credit. There's a couple reasons why it helps out. So first, it's similar to the auto loan, where it just shows that you can make a regular payment. If you eventually pay off your house loan, I mean, that is huge for credit, because they go, wow, this person, because most houses nowadays are what? Especially here in Utah, I mean, I think the average house price here is like $500,000 or something like that. It's astronomical. But if they're like, wow, this person can pay off a $500,000 debt, then we know that they're good for their payments, all that kind of stuff like that. So it really shows to creditors that you are committed and that you're also not a high risk person. The other thing with mortgages is this shows creditors that you have some level of stability in terms of housing, because a lot of houses obviously appreciate, and if you have a mortgage and let's say that you get into hard financial times, there's a lot of people that will take out loans against their house with, you know, home equity loans and all that. And so again, creditors go, this person has a little bit more stability in their life, so they're more willing to loan. And on top of that, it just, with the regular payments and all that, increases your credit score. Now, up to this point, I'm sure a lot of you are like, why the heck is this guy telling me to get into debt? He is absolutely crazy, out of his mind. And yes, I agree with you. And that's why the next talking point is doing everything in moderation. So like I said with credit cards earlier in the video, I don't recommend keeping money on credit cards. I recommend using them every single month, having a balance on them, and then paying off that entire balance before the end of the month so that you're not paying any interest on the credit card, you don't have any rollover debt on the credit card. And this just goes with living within your means. And this relates to the other stuff, like the car loans, like the mortgage loans, all that kind of stuff. So going out and buying a crazy big baller house that's at the top of your budget, going out and buying a crazy baller car that's at the top of your budget, just isn't the smartest thing if you want to have really good credit. And so really what you want to focus on is having a solid debt to income ratio. And this also affects your credit score, because if you have a massive amount of debt and you're basically paying out all of your monthly income to pay off different debts, then your credit score is not going to be that great. Versus if you have credit, right, you have a mortgage, you have a car loan, you use your credit card on a regular basis, but you pay off your entire credit card at the end of every month, and your car payment's very low compared to your income, and also your mortgage is not a massive amount compared to your income, then this is going to help out. And I understand, right, a lot of places like here in Utah, housing prices are going up like crazy. California, I'm sure if you live there, then you guys know housing prices are crazy, and sometimes it's just super difficult because of how expensive things are. I completely understand on that, but Again, that's one of those things where you are choosing to live there. And since you're choosing to live there, then you have to understand that, well, if I have to pay a ton for a house, then that means that I probably can't spend as much money on going out partying, and then I can't spend as much money in a car because, well, you've got to spend more money on housing. And so again, it's trying to keep everything in moderation, and keeping things in moderation is going to help out with your credit score. Now, if you guys want kind of hard numbers, again, on the credit card, this is your number, 0. I just don't think that you should keep any money on a credit card. I think that you should pay that off at the end of every single month, unless there was some crazy sort of program where the credit card was like, hey, if you keep money on this, then we'll give you all this money back. But for the most part, you still get the benefits of credit cards, even if you don't keep money on them, if you just have them and use them. And then in terms of a car loan, here's what I'd have to say is, I know that a lot of these recommendations and everything will say that you can spend up to 15% of your monthly income on a car payment. I do not agree with that whatsoever. I think that is way too high. Right now, with both of my car loans combined, my monthly payment and insurance and gas and everything is still less than 15% a month, and that's with 2 cars. And so I just think that if you're going to be practical and, again, live within your means, in my opinion, I think keeping your car loan at 2.5 to 5% of your monthly income, I think that that's the way to go. And so what this, again, looks like is, let's say that you want to get a car, and let's say that you make $3,000 a month, okay? Then you just do the math, and if you want to do the math super simple in your head, then you can just split it in half. 10% of $3,000 a month is $300. So if you want to go up to 5%, then you're going to be $150 a month. So you don't want your car payment to be more than $150 a month. And I know this might make it kind of difficult because you might not be able to get the exact car that you want. But again, this is all about living within your means, living in moderation so that you have money to save, and also you don't have massive payments on your credit. And in terms of the house, this one's a little bit more difficult because I think that it's better to have a house than to pay out rent. And so if you live in an area where housing is really expensive and you have to go up higher in terms of your income to get a house, again, I understand that. I'm a little bit easier about that because a car is a depreciating asset, whereas a house typically, depending on the area, most places appreciate over time. And so on a house, if you're able, what I would actually say is, I know most places will say that you can spend up to, like, I've seen 40 to 50% of your income, which when I hear that, I mean, it just blows my mind because I'm like, I can't imagine having half of my income every month going towards a mortgage payment. It's just ridiculous. I know a lot of people do it. I just can't imagine it. If you wanted to make things super simple and what's going to look great on credit because you don't have a ton of debt, I would say literally try to keep it 15 to maybe 25% of your income, if that all possible. Anything under 20%, and that would be absolutely fantastic, because just from your stress perspective and everything, you're not going to be crazy stressed out, because if you're spending 15 to 20% of your monthly income on your housing and that's it, then you've got the rest of the 80% that you can spend on all the other stuff, and that's a lot less stressful than, boom, half your paycheck, bye-bye to the mortgage. So again, everything in moderation. That is like the biggest tip of this whole video for credit and getting credit up quickly. So I feel like this video is getting just a little bit too long, so I kind of have to rush this end part so that this isn't just like a massive video. But just finishing up with the key points, again, to really increase your credit score at a quick rate, get a bunch of credit cards. However, don't keep money on them. Pay them off at the end of every single month, but make sure you use the credit cards. So if you just get credit cards, that is going to help out a little bit, but using them is more important than just having them. So if you use them every single month, pay them off at the end of every single month, that's going to boost your credit score very quickly. And then on top of that, most lending institutions offer what's called a line of credit on your bank account. I recommend just doing this just as like a safety measure. Basically what this is if you for some reason overdraw your checking account, then what that will do is it will then take money out of that account, put it into your checking account so that you don't get any fees from the lender or anything like that. I have one personally. I've never used it. I would just recommend getting it because it shows as another thing on your credit, which is good. It shows you have more credit, but I just wouldn't recommend using that because that means that you are spending more money than you have, and that's not what this video is about. But again, I would recommend getting that. And then in terms of auto loans, just have an auto loan. Make sure that obviously you make all your payments on the auto loan, and that'll help boost your credit quickly. Make sure you get something that fits well within your budget so it doesn't screw up your debt to income ratio. So my recommendation, 2.5 to 5% of your monthly income should be your monthly payment. I get it, if you want a really cool car, you can go above that. I just wouldn't recommend that if you're wanting to build your credit score up at a very quick rate. And then again, with the mortgage, same thing with the auto loan. Make sure you make all your payments on it and don't do something that's crazy. And that's huge with credit, is the whole debt to income, because if you've got way too much debt, it's just gonna throw everything out of whack. And so if you do all of those things in conjunction, so you have multiple lines of credit, and they're not massive to your income, so you're not spending all of your monthly income on paying down these debts, you're just spending small portions of your income on paying monthly debts, and so you have a bunch of money left over, then that is what's going to increase your credit at a massive rate. And I mean, like I said, for me personally, I started with the credit card, and after I did the auto loans, then my credit history built out. I literally went, just to give you guys an idea from an auto loan perspective, I literally went from the first car that I bought, I took out a loan of $15,000 on it, to the cars that I buy for the channel now, which is only a couple years later. I am buying cars like the Raptor, that was $70,000, the Supra, $50,000. And so I'm buying vehicles that are much more expensive over a very short period of time, because I've built up my credit so I can get really low interest rates on the cars themselves, and I can get those bigger loan amounts because I've proven that I can pay on stuff and all of that. And so those are kind of like those are the tips for getting your credit up quickly. Now that is gonna sum things up for today's video. I really appreciate you all for watching. If you're stopping for the first time, please subscribe and comment down below if you want me to make more videos like this that are kind of like finance type videos, even though they're not fully automotive related. Obviously these finance tips can help you to reach your automotive goals in terms of vehicles. And I mean, I get questions all the time, right? Because there's not many 23-year-olds driving around a brand new Raptor and a Supra and getting a new car every few months. So I get it that people want to know about this. And so if you guys want to know more about how I do what I do, then leave that in the comment section below. And obviously share this video, like this video, all that stuff, because if you guys get more traction on these type of videos, then since there's a monetary incentive for me, I'm just being honest, since there's a monetary incentive for me, then I'll be more likely to go and spend my time making them. I'll see you guys.